Research analysts who make a living valuing companies and sending trading ideas to investment managers have got a new challenge. They've got to prove their own worth. That's according to a recent Wall Street Journal article. It's thanks to a new European Union law that does away with research being financed by the commissions that clients pay each time they buy or sell shares via a bank. The law now requires investment managers to pay specifically for any analyst research or services they receive. This is Tonight. I'm Bruce Whitfield, and tonight I ask my guests, Vunani private clients Govender and Byron from Vestact, if it means that every analyst for themselves from here on. I wonder, do the analysts earn their bucks? Are they worthwhile people? Are they good people to have in a market, Byron Lotter?
I think so. I mean, they definitely earn a lot of bucks, but they do a lot of hard work and they create that information for the market to basically value companies.
They do a lot of hard work. Let's test the hypothesis. Don't these guys sit in cozy air-conditioned offices just like these, look at the results like you and me, make some assumptions, have a bit of a guess, lick a finger and see which way the wind is blowing, and then determine a value for a company.
Yeah, but there's a benefit of being a specialist. We were just discussing before we came on here about, for instance, our property analyst goes and looks at the actual buildings a property fund will have. So you haven't been to all the redefines properties. You haven't seen, the structure, the quality of the building, etc. Let's look at the shops and see how they're being run and so on. And those are the kind of things that you get from being a specialist in particular industry. So in our country, you have industry specialists. In some of the places, you even have particular stock specialists, like some people are specialists in Apple or Google.
But what is the value of a fund manager, or an analyst rather, let's be more specific, of an analyst going off and watching the foundations being thrown and then watching bricks being put upon one another, looking at the plans and talking to the foreman? What value does that bring to the investment process?
Well, I think if you look at it, in the market, there's different levels of expertise, and you look at the retail investor probably has the lowest, and the fund manager has a bit higher. But the analyst probably has the most expertise on the particular stocks that he or she covers. If you had to go and value a stock, just by looking at, for instance, P ratios, they can be fiddled with. You can value a stock looking by a certain, just the balance sheet and look at the financial statements coming out, and that doesn't give you the full impression of the stock. You don't understand what's the growth path, what the progress on research development is going to be like, what the actual plans of the company are they fully reflected, what the options and so on are in particular companies. Without the analysts there actually providing that bedrock of basically knowledge about particular companies in the market, I think the market would lose quite a bit of actual information.
Okay, so a big punt there for the analysts and the intrinsic work that they do, Byron Lotter. What does it add, though, to the investment thesis when you've got the specialist who knows probably as much as the CEO, if not more in some cases than the CEO does, about the moving parts within a business?
Well, these are underlying businesses. Many retail investors will see, I bought Discovery at 100 and I sold at 120, and they just put a number to it. But there is an actual underlying business there. For someone like me who doesn't specifically have the time to go to each company and have a look at what is going on the ground floor, I can read an analyst report, and it simplifies it. It saves time for a lot of fund managers to be able to have a look at what is happening at the business, trust what the analyst has to say, and that's where this discussion is going to come in about reputational risk and so on.
You get great analysts and you get good analysts, and there are very few lousy analysts because they get weeded out by the system. Nobody's going to pay an analyst a lot of money for being lousy.
It's a tough job to get into. You need high qualifications, and it's very competitive.
Okay, so analysts need to earn their keep. Why, if they're so good at their jobs, do mistakes happen? Do crises happen? Valuations go awry, and we don't get the analysts standing on rooftops and blowing trumpets warning us?
Well, I think there's a big difference. These guys are looking at company specifics. Often what happens when we see big crises come through, those are macro issues, not necessarily the underlying businesses. And of course, when the whole market comes down, those specific companies are affected as well.
Subprime is a case in point.
That's exactly.
Okay? So subprime was not a macro issue. Subprime was banks behaving badly. They were leveraging. They were taking too much risk. And when that bubble burst, there weren't too many analysts who'd been warning ahead of time that these guys were over-leveraged and they were taking too much risk.
I suppose they're just one piece of the puzzle. When you're looking to invest in a company, you've got to look at what the analysts have to say. It's nice to see what their expectations are going to be. But of course, it's not the overall, as an investor, you need to make a decision on what everyone is saying. You look at what analysts are saying. You look at your own personal opinions. You look at the business. You look at what managements are saying. And then you put those pieces of the puzzle together. And then you make your investment decision. Of course, it's always nicer to know whether, it's difficult with analysts where they actually have skin in the game, because that, of course, is very different. You know, an analyst can say, oh, I'm buy rating on this one for the next 12 months, but whether they actually own the share themselves is a different story altogether.
That's a risk as well. But also, Viv, isn't there a risk here that the analysts come too close to their subjects? In the same way as ratings agencies were criticised for becoming complacent, isn't there a risk of complacency creeping in? You've got an analyst who's been doing a great job for 10 years in a company who begins to cut corners, and we put a lot of faith and a lot of store in these analysts. What checks and balances are there to make sure that they're doing the jobs properly? Yeah,
of course, you would expect, an analyst that's friendly to a company gets, if not outright,
we've seen companies exclude analysts from briefings.
Yeah.
Astral's done it. The Advotech, I think, did it as well. Grumpy with particular fund managers or analysts or whatever the case might be. Those are guys you would hope are doing the jobs properly. Irritating management rather than being partners on a process.
Look, that is the case. And I think one of the reasons that this actual legislation is coming into play is actually to divide or separate analysts from another source of possible interference, which is the brokerage firm in which they're working. Because if you want to stimulate your trade, you want to make the people buy the particular stock, there's an incentive to hype the stocks that you are basically trading or you are analyzing, to encourage investment into it and therefore encourage trade and therefore commission. But another way to look at it is this: if you only pay analysts for the investment that you particularly want, so you'll only pay analysts that are looking at stocks that are currently in the bull trend or that you're looking to buy into. What happens to the stock that's not loved at the moment? What happens to the analysts in that particular stock? You may just get to a case where you actually reinforce these trends as opposed to actually getting a clearer idea of the market.
So who should be paying then for the analyst? Who should be paying the analyst's enormous salary to allow him to or her to drive the latest Aston Martin? Should it be the fund manager who pays a fee for particular research, or should I, as the ultimate customer, be paying a commission to enable the fund manager to pay the analyst?
Well, I think the original system is completely flawed, and that's the main topic we're going on and why they're changing the laws. Because what is happening is that the customer is paying the analyst fees, but in terms of commissions on how many trades are done on a particular stock. And that's completely incorrect. I actually read a book about it last year called The Buy Side. Okay. And it's about a guy called Tony Duff, and he's a hedge fund manager, and he's on the buy side. And he used to have dinners with all these sell-side analysts, and they used to give him tip-offs in order for him to trade through them. So, the incentives weren't correct. And obviously he imploded, and he used to go off with prostitutes and big coke binges and everything. That was the interesting side of the story.
No, of course. I mean, you've got to have that. Otherwise, it's not really a book. Yes.
But, these are the incentives that are incorrect. It shouldn't be on commissions paid by the end investor. It should be the fund managers that are paying.
Yeah, but the end investor is going to pay anyway. Whether the fund manager is paying a fee for a particular piece of research or it's coming through as a commission.
It should be based on the quality of the analysis that comes through.
And how do you judge then the quality of that analysis? Do you look?
Is
it retrospective? Do you sort of go at the end of a 12-month period? This was your recommendation. It reached that level. I mean, that's open to huge manipulation as well, though, isn't it?
Look at analyst reports. You don't just look at what the target price is. Otherwise, they'll give you a one blind report. You look at the entire report, because the report gives you a greater impression of what the company is doing as well. I mean, sometimes you might have the person having the wrong target price, but they give you a great overview of the company that you can basically put into your particular model and understand what your valuation of that company is going to be like. So you may have an analyst that's a bit more pessimistic or optimistic than you are, but his overall analysis of the company and the breakdown of the different parts of it are very important. But the one thing I want to bring it back to a real world example. Look at this situation right now with online newspapers. People want to get this information for free. When it becomes a paid-for source, people are much less willing to go and pay for this thing. It may just be a psychological aspect to it. People are saying, it's not from my bottom line as opposed to directly from the customer's bottom line. But it may just change the way in which people operate in the market, and that may be a negative, I think. The less information that there's out there, the more likely you're to make the wrong decision. More information does not increase the chance of wrong decision.
So what is the appropriate way of funding that very important research? By the fact that I'm delighted that there are people who've got the time, because they look at very few companies, to go out with a clipboard, or maybe it's a tablet nowadays, and to sit and look at the minutiae of whether the corners of the angles of the new pick and pay store are going to be adequate for future management teams.
Look, I don't think there should be a banning of basically commission-based payment for research. I think there should be great information to the client, so the client knows I'm paying this for particularly execution and for research, and that is what the client knows to pay for.
But I mean, you know, clients, both of you deal with private clients all the time. They don't have, the reason they have you guys is to do the work for them. They want to give you the money and say, do the best you can with this money. I need to go and do my day job. Off you go. So who is the client? Is the fund manager the client in this particular case, or is the end retail investor the client?
I think it should be the fund manager, because essentially they're the ones who are benefiting from the analysis and pushing it onto their clients and getting those management fees. You know, that's sort of what they're doing. And I think the best way to determine the price and who does it and the quality is just let the open market decide. I mean, for example, Gene Munster, he's a famous Apple analyst. He gets front row seats at all the Apple presentations.
Which goes back to my point exactly. He gets preferential treatment.
Well, he's worked his way there.
Yeah.
His analysis has proven to be correct over the years, and people respect his opinion. So if you're starting off analyzing Apple, you've got a long way to go before you can get to the front row seats of those presentations. And that's the way it should be, like in anything in life.
Yeah, you got to earn
the respect, and you got to earn the respect and the fees coming in from a fund manager to buy your analyst report.
I mean, the only example I can ever recall when it comes to the value of analysts is a guy called Andrew Cuff, who worked at Vestact Asset Management in the days. Look, he wasn't born yet. Specialized outsourcing. Do you remember specialized outsourcing? Have you read the history books about specialized outsourcing, Byron? Specialized outsourcing, Dave King's first company, listed it on the JSE. Company went mad. They had a single client, Umgeni Water. And Andrew Cuff went and did what an analyst should do. He went and said, so what do you guys do? And they said, well, we've got this client. Only one client? And he went and wrote this explosive report which led to the implosion of specialized outsourcing ultimately. He did his job. Now, if you paid for that piece of research, you got your money's worth.
Well, certainly. I mean, look, they are also more recently, I think, Meredith Whitney, the analyst who called Citigroup, to collapse based on the bad loans, etc. And she, I think, after that came out, and after it was proven to be right, I think at one point in time she was charging $100,000 an hour in consulting fees, which is obviously a very nice paycheck if you can get it. But you must also go back to the fact, if you look at, you go to the doctor, you don't ask your doctor which Novocaine do you use, which surgical instruments they're going to use. You're trusting if you're going to the doctor's going to get what he thinks is the best for your particular needs. If you're going to a fund manager, as long as the fund manager discloses this is what he's paying for research, I think you should leave it up to the fund manager to decide which research he wants to basically pay for, because he knows more than you, and that's why you're employing him.
Theoretically. Okay. Byron Lotter, the system's got to change.
Yeah, I agree. And I think just going back on the topic we're talking about now, I think analysts also perform a very good checks and balances act. There's a guy, David Einhorn, who runs a hedge fund in the US, and instead of looking out for longs, he goes and tries to find companies that are cooking the books, and then does deep analysis into the business, and then exposes them. Obviously, he shorts them first, exposes them, and makes money out of it. And even though the end game is to make money, and he's not doing it for the better of humanity, he's still performing a very important function within the market.
Fascinating perspectives this evening. Byron Lotter from Vestact and from Vunani Private Clients, Viv Govender. Thank you both for coming in. Nice to see you both. Their perspectives on the analysis that informs the fund manager's decisions to take your unit trust money, your pension money, and to invest it in particular companies, hopefully, ultimately, for your benefit at the lowest possible cost. There'll be more tonight, tomorrow. Till then, good night.